There's an idea that surfaces every few years, especially when government debt levels rise. The United States could revalue its gold reserves, increase the dollar value of those holdings on its balance sheet, and use that accounting change to address its debt problem. It sounds plausible. The U.S. holds over 8,000 tons of gold. That gold is currently valued at $42.22 per ounce on the Treasury's books, even though the market price is above $2,600. The gap is enormous. And when debt reaches $38 trillion, people start asking, why not just update the number? This isn't a prediction. It's not a secret plan. It's a structural explanation of why this idea persists, what it would actually do, and what it wouldn't. Stay with me. The common assumption. The logic goes like this. The U.S. government owns approximately 261 million ounces of gold. At the official book value of $42.22 per ounce, that's roughly $11 billion in assets. But at today's market price, that same gold is worth over $680 billion. If the Treasury simply revalued that gold to reflect current market prices, it could create a paper gain of more than $650 billion. That gain could theoretically be used to offset debt, fund programs, or stabilize the balance sheet. People who reference this idea often point to history. In 1934, President Franklin Roosevelt revalued gold from $20.67 per ounce to $35 per ounce under the Gold Reserve Act. That revaluation increased the dollar value of U.S. gold reserves overnight and helped recapitalize the Federal Reserve during the Great Depression. Later, under the Bretton Woods system, gold was pegged at $35 per ounce until 1971, when President Nixon ended dollar convertibility into gold. Since then, the official book value has remained frozen at $42.22 per ounce, a relic of that era. So the question becomes, if it was done before, why not again? How the system actually works. To understand what revaluation would actually mean, you need to understand how the gold is currently accounted for. The U.S. Treasury holds gold as a reserve asset. It's recorded on the balance sheet of the Treasury and the Federal Reserve at statutory value, not market value. That statutory value is $42.22 per ounce. This is not an estimate. It's a legal definition set by Congress. If Congress authorized a revaluation, the Treasury would adjust the book value of its gold holdings to a higher price. Let's say they revalued it to $2,600 per ounce. The accounting entry would look like this. The asset side of the balance sheet increases by roughly $650 billion. That increase would create what's called an unrealized gain. It's not cash. It's not revenue. It's a change in how an existing asset is valued on paper. Now here's the critical part. That gain could theoretically be transferred to the Treasury General Account, giving the government additional balance sheet capacity. But this does not mean the government suddenly has $650 billion in spendable money. Why? Because the gold itself hasn't changed. The government still owns the same bars, stored in the same vaults. The only thing that changed is the number written next to it. To actually use that value, the government would need to either sell the gold or borrow against it. Selling would flood the market and depress the price. Borrowing would add to liabilities. In both cases, the benefit diminishes or reverses. This is the difference between accounting entries and real economic outcomes. One changes a ledger, the other changes the flow of goods, services, and obligations in the economy. Why the idea persists. So if revaluation doesn't create spendable money or reduce actual debt, why does this idea keep resurfacing? First, it offers psychological comfort. When debt levels feel unmanageable, people look for solutions that don't require austerity, tax increases, or inflation. Revaluing gold feels like finding money you forgot you had. It's appealing because it seems costless. Second, it taps into a deeper belief that gold represents real value in a way that fiat currency does not. For those who distrust monetary policy or worry about currency debasement, gold revaluation feels like a return to something solid. Third, the historical precedent makes it seem feasible. If Roosevelt did it in 1934, the logic goes, why couldn't it be done again? But context matters. In 1934, the U.S. was on a gold standard. The dollar was directly convertible into gold. Revaluing gold changed the exchange rate between dollars and gold, which had real economic effects. Today, the dollar is a fiat currency. It floats freely. Gold is a reserve asset, not a monetary anchor. The mechanics are fundamentally different. What revaluation would and would not do? Let's be precise about what revaluation could and could not accomplish. What it could do. It could increase the nominal value of Treasury assets on the balance sheet. This might improve certain financial ratios or provide technical room under debt ceiling constraints, depending on how the law is written. It could signal a policy shift, indicating that the government views gold as a more central part of its reserve strategy. It could create a one-time accounting entry that might be used for specific legislative purposes, such as funding a program or recapitalizing an institution. What it would not do. It would not reduce the actual debt. The government would still owe $38 trillion to bondholders. Those obligations don't disappear because an asset was revalued. It would not generate revenue unless the gold is sold, and selling large quantities of gold would likely depress the market price, reducing the value of the remaining holdings. It would not address the structural deficit. The U.S. government spends more than it collects in revenue every year. Revaluing gold doesn't change that gap. It would not prevent inflation. In fact, if revaluation were perceived as a form of monetary expansion or a signal that the government is willing to debase the currency, it could increase inflation expectations. It would not restore purchasing power. The price of goods and services is determined by supply, demand, and monetary conditions, not by how gold is valued on a government balance sheet. In short, revaluation is an accounting event, not an economic solution. Outcome divergence. Here's where things get more complex. Even if revaluation were implemented, the public outcome would likely diverge from the intended outcome. Imagine the government announces a gold revaluation to $2,600 per ounce. Markets would immediately begin pricing in second-order effects. Bond markets might interpret this as a sign of fiscal desperation, increasing yields and making future borrowing more expensive. Currency markets might view it as a precursor to devaluation, weakening the dollar. Gold markets might rally initially, but then correct as investors realize the government now has a stronger incentive to sell. International creditors, particularly those holding U.S. Treasury bonds, might reassess their exposure. If revaluation is seen as a step toward unorthodox monetary policy, confidence in dollar-denominated assets could erode. Domestically, the political optics would be challenging. Revaluing gold to address debt might be framed as an admission that traditional fiscal tools have failed. That could accelerate calls for more aggressive measures, creating policy uncertainty. The constraints are real. The U.S. operates within a global financial system where credibility and predictability matter. Actions that appear to manipulate balance sheets without addressing underlying imbalances tend to backfire. Rational interpretation. So how should we interpret the gold revaluation idea? Not as a solution, but as a signal. If such a policy were ever seriously considered, it would indicate that conventional options, spending cuts, tax increases, sustained economic growth, are perceived as insufficient or politically unviable. It would suggest that policymakers are looking for technical maneuvers to buy time or create the appearance of action. But buying time is not the same as solving a problem. The real question isn't whether gold can be revalued. Technically, it can. The real question is whether that revaluation would change the underlying fiscal dynamics. And the answer, based on how modern monetary systems work, is no. Debt is a function of spending relative to revenue over time. It's addressed through growth, taxation, inflation, or default. Revaluing an asset on a balance sheet doesn't fit neatly into any of those categories. What it does do is shift the conversation. It allows people to imagine a way out that doesn't require sacrifice, and that's why the idea persists, even when the mechanics don't support the narrative. Closing reflection. The gold revaluation idea is a reminder that systems and narratives often diverge. People want to believe that complex problems have elegant solutions, that somewhere in the architecture of government finance, there's a lever that can be pulled to make the numbers work. But modern economies are not balance sheets in isolation. They're networks of expectations, incentives, and constraints. Changing one number affects how people perceive risk, how markets price assets, and how institutions behave. Gold revaluation might look like a solution on paper, but paper doesn't account for confidence, credibility, or the second-order effects that ripple through a global financial system. This isn't about predicting what will or won't happen. It's about understanding the difference between accounting and economics, between what can be done technically and what would actually change the outcome. The idea will likely resurface again, especially as debt levels rise and fiscal options narrow. When it does, you'll know what it means and what it doesn't. Not because you're reacting to headlines, but because you understand the system. Thanks for watching.